Okay, so welcome to Earnings Unscripted. Today we have a company literally firing $10 laser beams off active nuclear supercarriers to melt incoming drones. I mean, it doesn't get more sci-fi than that. We're looking at AeroVironment's fourth quarter for 2026, ticker AVAV. Today is June 29th, 2026, and they just posted a record-breaking quarter, but the market reaction has been pure whiplash.
Yeah, whiplash is definitely the word. Because look, if you just read the top line, it is flawless. Revenue hit $641.6 million. That is up roughly 57% quarter over quarter. Operating income went from a disastrous $79 million loss in Q3 straight to a $56.9 million profit. I mean, EPS came in at $1.25. They completely crushed the immediate comparables.
Right, and you really see that whiplash in the tape because during the quarter, the stock actually bled out. It dropped about 32% over the fiscal quarter, just trending sharply lower. But then this print hits and boom, it pops nearly 22% in extended hours. People just saw that EPS bounce and smashed by.
Right, which is probably a good time for the obligatory reminder that this is just our personal opinion, not financial advice, so please do not go mortgage your house to buy defense stocks just because the after-hours chart is green.
Exactly. We just like talking about the mechanics. And honestly, the physical mechanics here are wild. I want to touch on that Locust system first. They mounted this laser on the USS George H.W. Bush, and it melted 100% of the test drones out on the ocean. The CEO noted it costs under $10 a shot. That completely flips the math on firing $1 million interceptor missile at a cheap drone swarm.
It fundamentally breaks the offensive cost advantage, and you see that demand showing up everywhere. Autonomous systems revenue surged 77% this quarter. The core business with Switchblade and Titan is clearly humming along. Funded backlog is sitting at $1.2 billion, so everything points to massive scale. The problem is they just told everyone free cash flow for next year is going to be negative.
Yeah, which is such a buzzkill. They finally stopped burning cash. They hit $73 million in positive free cash flow for Q4, and then they basically turn around and say, hey, expect negative cash flow for all of fiscal 2027.
Well, they are plowing up to 14% of total revenue into CapEx. They want to build a loitering munitions factory in Salt Lake City that can push out $2 billion in product a year. Just think about that. That capacity matches their entire current annual revenue in one plant. It is an insane thermal budget for capital. Plus, management is overtly blaming election year politics, saying government continuing resolutions are probably going to freeze new spending until roughly March.
Okay, so they're heavily discounting their near-term government revenue because of DC politics, but at the very same time, burning cash to build their biggest factory ever. That feels a bit disconnected. All right, let's get into the details on that.
I mean, it only looks disconnected if you ignore how fast they grew through acquisitions. They are rushing to build that factory for wartime demand. But honestly, the sheer speed of merging something like Blue Halo into the core business, it is actually starting to break their financial plummet.
Oh, you're talking about the accounting thing. Yeah, I saw that material weakness notice and just kind of winced.
You and the entire investor relations team. Look, nobody likes a Sarbanes-Oxley material weakness, but this one is almost comical because they outsourced the math.
A third party broke the audit.
Right. So an external accounting firm bungled the third quarter numbers. Do you remember that massive SCAR program termination they had to write down last quarter?
Yeah, the Space Force contract.
Exactly. So when they calculated the goodwill impairment for that, the outside firm completely missed roughly $89 million in acquired tax attributes. They just left it out. And management caught the error in Q4.
That is a wildly expensive typo. How does someone just forget $89 million in tax assets?
Well, the CFO was pretty blunt about it on the call. He said, and I'm quoting here, an estimated allocation of goodwill associated with the acquired tax attributes were not included. So now they have to do all this heavy remediation testing moving forward to prove their internal controls actually work. It's just a headache of buying your way into scale.
It is the completely unsexy side of defense tech. I mean, everyone wants to talk about melting drones with lasers, but no one wants to talk about reconciling legacy tax ledgers.
It's entropy. And that same friction is actually bleeding into their margins too, because product gross margins are incredible right now. They hit 44%. But if you look at their service segment, it basically cratered. Service gross profit posted a $9 million loss this quarter.
I actually missed that. A straight loss on services?
Yes, it's effectively a 2% adjusted margin once they cleared out the noise. But the catalyst was a forward loss on an old legacy contract.
Also because of the merger?
Yeah, they called it an indirect rate realignment, which is really just accounting speak for saying, when we merged Blue Halo into AVAV, the new combined overhead structure suddenly made a previously profitable contract completely unprofitable. The estimated completion just went underwater.
Okay, that is so interesting because you buy a company for synergies and instead you just get, a heavier backpack. The corporate overhead suddenly crushes the contracts you already had signed.
That's exactly the issue. You get the space age scale, but the back office landmines detonate for the next year. And to be fair, they're also facing friction on just getting paid for the stuff they actually successfully build.
The Switchblade deliveries.
Yeah, the government has these incredibly extended acceptance testing cycles now. So AeroVironment is building the munitions, putting them on shelves, but they can't convert them to cash until the government formally tests and accepts them. So it's tying up a massive amount of working capital.
Which loops us right back to why they're guiding to negative free cash flow. If you have to float the cash while the government takes its sweet time testing, and you're actively building a $2 billion capacity factory,
and the government freezes new defense spending until March because of elections, yes, you are essentially running a thermal budget at redline.
Man, okay, let's actually step back and look at that broader picture, because zooming out here, I want to figure out what this means for their actual trajectory going into next year.
The trajectory is basically a giant waiting game. Their full-year guidance is decent. They are projecting roughly 10% top-line growth, pushing up to about $2.2 billion in revenue. But they are essentially writing off the first half of the year.
Oh, right, because of the election year continuing resolutions.
Exactly. The CEO actually said on the call, and I am quoting here, they probably are not going to see those dollars until the March timeframe. They are overtly assuming the U.S. defense budget just stalls out.
That is just wild to me. I mean, you're building the absolute bleeding edge of autonomous defense, and management has to sit there and tell Wall Street, yeah, our main customer is essentially broke until spring, so just hang tight.
It is absurd, but it is the reality of government contracting. So because of that, their Q1 EPS is expected to be only 25% of the first half's total. The whole year is heavily backloaded. But look, I actually think that negative free cash flow target for 2027 is their biggest long-term advantage.
Wait, I was going to say, how is bleeding cash an advantage?
Because it builds a massive moat. If you are a competing defense startup, you do not have the capital to just build a $2 billion capacity plant in Salt Lake City on spec. AeroVironment is willingly eating negative cash flows to lock down that manufacturing scale before anyone else can even break ground.
Okay, right. That makes sense. It's basically capital exhaustion. They're saying we can endure this pain and you simply cannot, which is exactly what you want to see if you're a long-term investor looking past the political noise.
Right. The strategy is solid. The only immediate wild card is that accounting weakness we talked about. I would say the main thing to watch next quarter is whether they successfully remediate that internal control issue. Because markets will tolerate cash burn for future growth, but they will not tolerate sloppy bookkeeping.
Very true. All right, well, I think we have safely navigated the entire spectrum today, from $10 lasers melting drones out on the ocean all the way to, third-party audit typos.
The true duality of modern tech.
Exactly. Thanks for tuning in, everybody. We'll catch you on the next one.
See you out there. And
If you want these earnings breakdowns to just show up in your feed, following the podcast is the easiest way to make that happen. Just as a quick aside, this entire show is generated with AI to explore how well technology can build a human conversation directly from raw financial data. We'd love to hear from you, so if you have feedback or a ticker you want us to dig into next, email us at earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for listening.
Catch you next time.